Welcome to the Swing Trading Strategies video series. In this video, we will learn about ADX indicator trading strategy that combines ADX indicator and moving averages. I've covered swing trading in great depth, and in case you've landed directly on this video, do watch the remaining parts of Swing Trading Strategy series. Link to all these videos is given in the description box below. So by the time you finish this video, you will have learned how to use this simple ADX indicator trading strategy for swing trading and how to apply this strategy to identify high probability trades and time your trades to perfection with well-defined stop loss. So what I'll do is I'll take you through some basics of ADX indicator and will then show you how to combine ADX indicator and moving averages together. This trading strategy was first given out by Linda Bradford Rashke, who remains one of the most influential trader of our time, and this particular setup works exceptionally well. I will also show you some modifications that you can implement in order to enhance your return. In the end, I will show you how to trade this setup by defining risk, entry, stop loss, and exit. So let's get started. So let us first begin with the basics of ADX indicator. Now ADX primarily is a trend strength indicator. It's mainly used to determine the strength behind a trending move. On a standalone basis as such, ADX indicator does not indicate the direction of trend. Now remember this important point here, that ADX indicator only highlights the strength of the underlying move. I hope this point is clear. So ADX is calculated based on moving average of price range extension that is taken over a period of time. If you're interested in learning about ADX indicator construction and calculation, there are plenty of resources freely available on Google. Do refer the same for calculation segment. So default parameter for ADX indicator is 14. However, traders can experiment based on their own preference and own experiences. Now, when you plot the ADX indicator on a chart, you'll find two more lines along with this, that is the positive DMI and the negative DMI. Now DMI here stands for directional movement indicator. So positive DMI represents positive direction of price, whereas negative DMI represents negative direction for price. Now when positive DMI is above the negative DMI, prices typically move up, and when negative DMI is above the positive DMI, price usually moves lower. So I'll just explain this to you on a chart. So this chart that you see in front of you has the ADX that is plotted in blue. I hope it's clearly visible. Positive DMI, that is directional movement indicator positive, that is highlighted here in green, and the negative DMI is highlighted in red. I hope this much is clear. So here you have price along with 20 period exponential moving average, and this is the Nifty IT index. So in some instances you are seeing that positive DMI is greater than the negative DMI and ADX is rising, whereas in some instances you are seeing that negative DMI is greater than positive DMI and ADX is rising. So there are times when ADX does not rise at all, and hence that indicates weakness of trend. In the chart in front of you, whenever ADX is greater than 30, I have marked this 30 level with a horizontal line. This is black line. So whenever ADX is greater than 30 and positive DMI is above the negative DMI, that suggests positive momentum in price. Now, if you look at this point where ADX is above 30 and positive DMI in green is clearly above the negative DMI, look how price trends upwards. So this is just one of the application of ADX, and I'll be coming to the detailed aspects of ADX once we start covering this particular strategy. So before we move forward, it's important to classify ADX into measurable parameters. That is, what qualifies as a strong trend and what qualifies as a weak trend with respect to ADX, and how to interpret the same. So this chart that you see in front of you is the ADX and DMI trend strength chart. If you want, you should take a screenshot of this particular chart, as it will help you understand this concept better. So when ADX is below 30, that is between 0 and 30, and positive DMI is above the negative DMI, trend is naturally up, but the strength of the trend is weak. Similarly, when ADX is below 30, that is between 0 and 30, and negative DMI is above positive DMI, then trend is down, but the strength of the trend is weak. So trend is typically strong when ADX is between 30 and 50, and it is very strong when ADX is between 50 and 80. I hope this particular point is clear. Now, once ADX starts rising above the 80 mark, that is between 80 and 100, avoid considering it and wait for it to cool off, as it suggests excess in trend over short term. I hope this point is also clear because this is extremely important. So the regions that you have to target for this particular strategy is between 30 and 50, and you have to hope that you catch on to such a trend where ADX moves from 30 to 80. That is when you will make maximum money in this particular strategy. So let us now quickly move to the ADX system suggested by Linda Bradford Rashke. From here on, I'll be referring to her as LBR. So again, this trading strategy based on ADX that I am going to explain is that of Linda Bradford Rashke. And I will suggest some changes as well to this once you understand the trading strategy, but this I will take up towards the end. So this is an extremely simple trading strategy which works exceptionally well for swing trading. Now LBR recommends using ADX 14 and 20 exponential moving average for this particular trading strategy. The time frame that she recommends is daily time frame, and for swing trading she recommends selecting only those stocks whose ADX 14 is greater than 30 and rising. So let us now move to how the trading strategy is set up on charts and what are the rules for this particular trading strategy. So this chart that you see in front of you is the daily time frame chart for Yes Bank futures. On the chart we have a 20 period exponential moving average. The rules for this particular strategy are as follows. Rule number 1, ADX 14 on daily time frame has to be above 30 and rising. Rule number 2, look for a retracement of price towards 20-day exponential moving average. Now, while retracement is happening, ADX 14 may experience some dip. That is, you see here ADX is heading down while being above 30. Now this is totally fine. Rule number 3, when price touches the 20 EMA, look at this candle here, it is touching the 20 EMA. Buy next day or on the following sessions where high of this candle which was touching the 20 EMA is crossed. I hope this particular point is clear because it's a very simple rule. Again, I'll repeat. Rule number 3 is wait for price to pull back to 20-day exponential moving average, and once a candle touches this 20-day exponential moving average, take the high of the candle, draw a horizontal line and wait for this high to be crossed in subsequent candles. As soon as this high is crossed, you enter the trade with stop loss. That is rule number 4, being the recent swing high. Now the stop loss section I will be covering up later in examples because it is kind of subjective, but this is what LBR recommends. So again, these are the 4 basic rules for this trading strategies. These are really easy to understand and you will be amazed with how this works for swing trading. Now I'll explain this a bit more on price charts and then I will walk you through with a complete example for this particular trading strategy. So this is the price chart of the previous example. I've just expanded the price section and removed the ADX part for ease of understanding. Now I have marked out 2 trading setups based on this particular strategy. So each time price, that is candle, touches 20 EMA, go long in the subsequent sessions if high of the candle is crossed. So these 2 candles that are marked here, these are the ones that touch the 20 EMA. And what I've done is I've expanded this section here and I have expanded this section here so that you can understand this better. So once we have this criteria, that is candles touching the 20 EMA, what we have to do is just draw a horizontal line here, right, across the high prices. And when price crosses it in subsequent session, we just enter, keeping the recent swing as stop loss. Now for this particular setup, this would be the stop loss. And here, this is the candle. This is the same candle as this one, which touches the 20 EMA. And once this happens, you draw a horizontal line across the high. And when the high is crossed, you enter the trade with this being your stop loss. So in the slides ahead, I will explain one example as it plays out on a daily time frame chart. So this is the exact same setup on the short side of the market. Now rules for this trading strategy as a short selling strategy are as follows. Rule number 1, ADX 14 has to be above 30. Rule number 2, when price is below the 20 exponential moving average, wait for a retracement to happen till 20 exponential moving average. Rule number 3, when price touches the 20 exponential moving average, short sell next day or in subsequent session if the low of the candle that touches 20 EMA is crossed on the downside. And rule number 4 is the stop loss. That stop loss for short selling would be the recent swing high that is formed. So if you take this particular case here, there are 3-4 setups that are formed on the chart. If you look at this particular setup, this is the candle that has touched the 20 exponential moving average. So what you do is you draw a horizontal line across this candle, and as soon as next day the low of this particular candle is breached, then you enter the trade and put a stop loss at this particular swing high. Now if you're a conservative trader, you can use this particular swing high, and if you're an aggressive trader, you can use the major swing high. Again, I'll explain these concepts in a particular example. So let me show this on price chart alone. So as shown on the chart, each time candle touches the 20 exponential moving average, mark out the low point of the candle that touches the exponential moving average. And if on subsequent days low is crossed, open a short trade with recent high as stop loss. So if this seems confusing, do not worry, just stay with me, as in next few slides I will show you how this is done with a particular example on a daily time frame chart. So let us now understand the role of exponential moving average in this strategy. So this ADX trading strategy by LBR uses an exponential moving average to identify the trend. I would actually recommend the same thing because exponential moving averages stay closer to the price. Now prefer only those stocks where 20 period exponential moving averages is moving up, that is if you want to trade on the long side, and prefer only those stocks where exponential moving average is moving down with price if you want to go short. So if you want to experiment with moving average parameters, you definitely can. Now there are traders who prefer something like a 21 period average or a 34 period average, and this is totally fine. However, I would strongly recommend that do not use a 50 EMA or a 100 exponential moving average, as this would result into fewer trades by this particular strategy. Now remember one thing, that you are essentially looking to trade the pullback in this strategy, and number of time stock pulls back to a 50 or 100 exponential moving average is far less than number of times a stock typically pulls back to a 20 period exponential moving average. So I hope this particular point is clear. Now as far as time frame is concerned, only use daily time frame. On daily time frame, use a 20-day exponential moving average. Now these were the parameters that were given by LBR herself. So avoid using this particular strategy on a shorter time frame, as this would lead to whipsaws on long or short side. Now as a golden rule, I would suggest that avoid stocks where trend is not clearly visible. This would actually include those stocks that are clearly in a well-defined range. So best time to trade this strategy is when stock is breaking out into a trend after a period of consolidation. I'll again come to this part towards the end of this video. So let me now come to stock selection for this particular trading strategy. Now LBR recommends stocks that are exhibiting uptrend or downtrend that are clearly identifiable with ADX 14 greater than 30. Now this is the core selection criteria for this particular trading strategy. Now remember one thing, you are swing trading here and you want to maximize your profits with the next swing in market. Therefore, I think it makes sense to select stocks that are more prone to swings in the market, and in my opinion, these stocks would be high beta stocks with beta value greater than 1.3. Now, high beta stocks are more prone to swings, making them an excellent choice for any swing trading strategy. If you recollect, in this particular swing trading strategies, I have highlighted the importance of high beta and swing trading many a times in my videos. So you can get a list of high beta stocks if you are using a software like ME Broker or Metastock. In case you don't have these softwares, I have posted the beta code for tradingview.com in the comment section below, and you can use the same to identify high beta stocks. So let me now take you through an example of executing this trading strategy where I will be showing you how to approach this on a daily basis. So before we move forward in this particular strategy, keep two specific things in mind about the candle structure that I'm going to show you for this trading strategy. This that you see here, these are long wicks of candle. Now, whenever you see long wicks on the upside, think resistance. Now, this that you see here, these are long tails of candle. Whenever you see this, think in terms of demand. Now, these two basic concepts will come in handy going ahead, as a lot of price action analysis with respect to this strategy depends on wicks and tail of a candle. So this chart that you see in front of you is of JSW futures. Now, based on the ADX trading strategy that we have discussed, let me now show you how this strategy needs to be implemented on a daily basis. I have handpicked this perfect example for you that played out in October 2018. Such clean structures don't exist always, but to give you hands-on experience of how to think in this strategy, I will have to use this example. I will also acknowledge that while explaining you things, I have the benefit of hindsight. So ADX for this particular stock is above 30. This signifies trend strength is strong. Also note negative DMI here, that is in red, is clearly above the positive DMI. And therefore trend is strong on the downside. I hope this categorization of ADX, negative DMI and positive DMI is now clear to you. You also need to see that price is below the 20 exponential moving average, and the candle which took price below the 20 exponential moving average is a wide range candle with fairly negative closing for the day. Now, based on the entry method that we discussed, we will now wait for a candle's high to touch 20 exponential moving average and will then wait for the low of this candle to be breached. I hope this particular point is clear as well. Now, stop loss again would be the recent swing high. So in this chart, we see that second day gets completed with price below the 20 exponential moving average. If you look at the candle here that has got completed, again selling pressure at higher levels is clearly visible. Look at the wicks, that is long wicks of this particular candle. Also, it's clear that price found it difficult to get past the 20 exponential moving average. If you see, ADX is sloping on the downside, but that is fine. Negative DMI is still above the positive DMI, clearly reflecting the bias of the market. One important point I want to make is that always keep track of individual candles that are printed on a daily basis. Keep a record of these candles in terms of bullish, bearish or neutral candles. This will always help you know who is in control, that is buyers or sellers. So this is the third session where price is below the 20 exponential moving average. Again, a supply candle is visible at higher levels. You can again see long wicks of a candle here. So as of today's price action, no entry is available to short sell this stock. Price broke down below this 20 exponential moving average with a wide range bearish candle. And after that, out of the three candles that are formed, two are bearish and one is neutral. Again, no signs of any strong buyers present in the system yet. So one more bearish candle forms with range extension on the downside. Also, we have formed a new low for this particular down move. No signs of entry yet on this day. Also, all these long wicks that you're seeing here, these now become strong resistance region along with the 20 exponential moving average acting as resistance. So I hope you're understanding how to think this through. So in this particular day, what you see is you do get a strong candle. Now you have to remember one thing, that this candle is strong. There is no doubt about it. but this region that is of long wicks will act as a resistance, or you should anticipate that this would be acting as a resistance along with 20 exponential moving average. So even as of today, nothing changes. Negative DMI is above the positive DMI. ADX is clearly above 30. Price again is below the 20 exponential moving average. No signs of entry as no candle has touched the 20 exponential moving average yet. So this marks the sixth session where price has broken down decisively below the 20 exponential moving average, but still there is no definitive sign of buying emerging yet. Apart from this particular candle here, there is no strong candle formation on a chart. Now sellers, as per what we have seen till now, are in total control. There is no sign of any entry as well. Remember one thing, for an entry condition, first we need high of a candle to touch the 20 exponential moving average, and then the low of this particular candle has to be breached on the downside. So in this session, we almost have a candle that is touching the 20 exponential moving average, but still there is no decisive entry point here. Now some bit of supply is again visible at higher levels in terms of these long wicks, but the important thing that you have to see is that this is still a borderline case. So this session was again negative. Fresh low is seen for this down move. Price for now is drifting away from 20 exponential moving average. Again, there is no sign of entry. If you look at the negative DMI, it is also moving near the 30 mark. So this is the 30 mark here. This negative DMI is hovering around the 30 level. Now this also suggests that trend is extremely strong on the downside. Now you have to keep seeing these subtle little signs such as candle strength, negative DMI or positive DMI structure along with the structure of ADX. Now LBR recommends that ADX should be above 30. That represents strong signal. So naturally when negative DMI or positive DMI moves near 30 or above 30, that actually signifies extremely strong trend on the downside or upside, depending on which, that is negative or positive DMI, is above or near the 30 mark. I hope this particular point is clear as well. So in this session, we have had a strong candle where high of candle has almost gone past 20 exponential average. Now again, this is a borderline case, but LBR suggests that one should wait for a well-defined entry instead of chasing such partial ones. So ADX is still above 30, negative DMI is still above positive DMI. And remember one thing, the long wicks that you see here, all these will be acting as resistance along with 20 exponential moving average. So this session I would again consider as a bullish session, though the candle is not that strong and some sort of selling has emerged at higher levels. Now despite of some sideways session and the two bullish candles that you see here, there is no meaningful pickup happening in the positive DMI. So this session is still relatively fine because price has managed to stay near the highs of this candle, which was the previous session, for a whole day. Although in terms of strategy, again, there is no sign of entry as candle did not touch the 20 exponential moving average. So in this session, we finally have a candle that moved above the 20 exponential moving average and then closed below it. Now long wick again suggests supply at higher levels. So based on whatever rules we have discussed, we now have a perfect setup as per this trading strategy. Now the low of this candle needs to be breached and we will then have the entry on the short side. So on this day, one would have entered the trade at 372 where the previous day's low was breached. So based on the rules illustrated by LBR, this is a perfect setup for short entry for this particular trading strategy. Now recent swing high now becomes the stop loss. I have marked it on the chart. In case you are an aggressive trader, you can also take this swing high as stop loss. So nothing significant to report for this day. Price opened lower but moved up during the day. Again, selling emerged at higher levels and formation of long wicks is seen. Now violation of setup only happens when the recent swing high is breached. Now till then, any form of random noise has to be ignored As a rule of thumb, always remember that as markets head lower, counter trend reactions are always swift and with momentum. This is the nature of down move and you will have to embrace this. So in this session, we got a weak candle. This session candle has actually engulfed the body of the previous session. And again, the highs have not surpassed the high of the previous candle. Also note that this particular candle forms a new low for this particular down move. So again, I hope you're seeing how at times we are using tails or wicks or engulfing patterns to analyze price structure better in order to determine who is in control, whether the buyers or sellers. So further down move is seen in this candle. Price has now come down from 372 to 348. Look at how consistently negative DMI is trading near the 30 mark while ADX remains above the 30 mark. This clearly signifies that strength of trend on the downside is really strong. So very similar session to what we had a day before. Narrow range candle is formed where the range of the current candle is completely inside that of a previous candle. This is also known as an inside bar pattern and it signifies volatility contraction. Now this is another session where range of this candle is within the range of the candle I am showing on the chart. So now we have two back-to-back candles in a row that are very narrow range in nature and are forming a double inside bar pattern. Now whenever volatility contraction happens, you will see that range gets violated on either side and that typically happens with momentum. So now in this session, you see a wide range candle forming, which is very natural once you see two or more back-to-back inside day bar patterns. So volatility as such was contracting. That is why range was moving lower. And whenever you see this happening, you will have volatility expanding on the upside and price will either begin to move up or begin to move lower. So note how negative DMI is continuing to trade higher and this is happening when ADX is again starting to move up. Again, these are subtle signs that you always have to watch out for. So this is not a significant session except that price has not shown willingness to move down further. This current candle is more or less in line with the long tail candles that we saw before we started taking up this example. And such patterns typically mark pause in the current move. Just keep this thing in mind with that whenever you see a long wick forming or a long tail forming, always remember that these patterns have to be confirmed and they cannot be viewed on a stand-alone basis. So another session where we get a long tail suggesting sort of a pause in down move or reluctance of price to move down. But with respect to trade and the overall trading strategy, you have to know that nothing significant changes as price is moving down. It is below the 20 exponential moving average. ADX is still above 30 and negative DMI, while being above the positive DMI, is trading close to the 30 mark. Again, emphasis here is to ignore the random noise that is generated while being in trade and focusing on the rules that you have in front of you. So in this session, price has moved up, candle is reasonably strong, and it has come on back of two candles which were clearly depicting long tails. However, as I mentioned earlier, do not forget that while trading short sell trades, you have to be prepared for candles that scare you, and counter trend moves as such are always fast and scary. In this session, we get a candle where price has crossed the 20 exponential moving average. And then we see long wick forming, which actually represents selling at higher level. Also, if you look, first time it is that positive DMI has moved towards upside. But in terms of overall strategy, always remember that these moves within the trade are random noises and you have to ignore these. Now, there are two key things that you have to remember here. Number one, long wick that is representing selling pressure ahead. Number two, trend is down as suggested by this particular trading strategy. Price is below the 20 exponential moving average. ADX is clearly above 30 and negative DMI is clearly above positive DMI. In this session, you again get a candle that has moved above the 20-day exponential moving average, and then it has faced supply at higher levels. Again, the concept of long wicks at play here. So for this strategy, long wicks and long tails, again I will repeat, give subtle clues about shift in demand and supply. So for someone who has not taken a trade at this particular level, a second entry is now available, and you have to wait for breach of low of these candles that have crossed the 20-day exponential moving average. So in this session, we again get a supply candle with a long wick, clear indications that on higher levels, selling is appearing on a consistent basis. So this is turning out to be very similar to what we saw between October 1st, if you see, and October 15th, where a lot of long wicks were being formed, suggestive of the fact that there is selling pressure at higher levels. Again, there is no fresh entry signs, though low of all these candles need to be breached. In this session, we have seen that lows of previous 2-3 candles have been breached, and hence someone who could not have taken trade earlier can take it now. So entire process, if you see, is very simple, and it only takes some practice to execute this strategy perfectly. So what I'll recommend is that you can practice this strategy on historical charts, and the best part is that you don't require any advanced technical software for this. So I hope by now you can see how on a day-to-day basis you have to look for signs of demand and supply with candles within the context of this trading strategy. You will have to keep a tab on candles, ADX and DMI. You can also use candle volume charts so that you get an idea about candle strength, but this particular subject on candle volume and this strategy I have taken up towards the end of this video. So remember one thing, that this is a very simple trading strategy, and do not add more variables to complicate it. Focus on keeping things simple and attempt to master this simplicity of this particular trading setup. So this is the entire chart of JSW futures. We had only seen till this particular point, and after the first and second entry, price actually steadily moved lower. So in this entire chart, you can spot at least 4 entry points, that is at this particular place, this one, this and this particular entry point. However, the important question here is which entry point is the strongest and why, and which entry points you should target for a trade. See, the thing is, if you want to become a successful trader, start thinking in terms of probability and not certainty. What I mean by this is that odds of trade being a success at first point is high. At second point, odds reduce as price has already fallen. At third point, if you see, odds reduce further because price has now been in a consistent downtrend. And at any point, a substantial counter trend rally can develop. At point 4, if you see, odds greatly reduce for the reasons I've just stated earlier. So therefore, the probability of trade reduces with each entry you take. This applies more for short selling as price falls for a limited time when compared to the time that price can trend higher. So as a rule of thumb, the reason why I have shown you this particular chart, that as a rule of thumb, always target the first 2 trading signals that you get while you are short selling. After the second signal is complete or the second trade is complete, reduce your position size by 50% at least for the third and subsequent signals. Again, this is only till when you don't see a major retracement playing out. But the underlying message is very clear: do not chase every signal on the downside. So let me now come to a section of improvements and some key points for this trading strategy. So one of the improvements I thought of was using relative strength to filter strong and weak stocks. So if you get a buy signal and relative strength of that stock is strong, then that would become a high probability trade and vice versa. Now I have made a 3-part series on relative strength. Those of you don't know about comparative relative strength should check out these video. This is completely different from the RSI indicator. Link to all these videos will show up at the top end of your screen. Let me just show you this point that I've mentioned on a chart. So this is the relative strength chart when compared to Nifty. This is the standard price chart of JSW futures, and this is the relative strength line of JSW against Nifty. So as price has moved lower, relative strength versus Nifty is also moving lower. So clearly this is indicating underperformance with respect to Nifty, making it an ideal candidate to short sell. So if you're interested in short selling, you need to look at weak relative strength stocks where RS line is clearly moving lower. And if you're looking for buying based on this particular trading strategy, you should look at strong relative strength stocks where RS line would be clearly moving higher. So this way you stick with weak stocks when you want to short sell, and you stick with strong stocks when you want to buy. Also, one more recommendation that I have is that you should be viewing price action with candle volume charts. So this would actually help you visualize demand and supply candles better. Let me again just show you on chart. So this is the candle volume chart for again JSW futures that we just saw as an example. So look at how strong volumes are on the downside. Now this is something that is not visible on a standard candlestick chart. So when you combine this strategy with candle volume, you will again increase odds of success. So case in point for this chart, if you see major volume across candles is present whenever price is attempting to move down, and look at the candles where candle volume, that is where price is attempting to move up, there is hardly any volume in that particular move. So what I'll recommend here is that first practice this concept on long only trades on equities. Futures should be avoided in the beginning. Time frame again is very important. Prefer daily time frame only. For improving odds of system, be mindful of broader market trend. So if broader market trend is up, prefer long trades. If the trend is down, prefer short trades. Golden rule of trading is to align with trend and then trust it fully. The key here for this particular trading strategy is to practice this on historical charts and then to take notes. You need to practice long trades on at least 10 stocks with a time span of 5 years of data. Do not skip this process. You will learn so much in this practice phase that you will be able to handle all the situations that come up in real-time trading. Now, too many traders actually commit a mistake of learning something and then trying to earn money off it on the following day. This just does not work this way. Trading is a long-term game and you need serious practice to survive in this business. Now, whether it is position size, stop loss, exit, or stock selection, you have to focus on all these elements while practicing on historical charts. So let me know in the comment section below if you have any doubt about what I've shown you, and if you have some suggestion to improve this further, do let me know in the comment section below. So all credit to Linda Bradford for this highly effective yet simple trading strategy. So thanks a lot for watching this video, guys. In case you have liked what I've shown you, do share this video and hit the like button as well. So let me know in the comment section if you have any doubts. Take care and be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.